More volatility in the markets and uncertainty for the outlook, thanks to the usual suspects of trade and technology disputes. An update of our view going into spring for interest rates, the housing and equity markets, and the broader economy. The familiar trend of trade wars and brinkmanship has intensified around the world, adding volatility to exchange rates and stock markets, and taking its toll on business investment, especially in manufacturing businesses. Manufacturing surveys around the world have been steadily declining for over a year now, especially in East Asia, as the chart shows. But now the US are also suffering from the trade wars that they initiated, and the recent inversion of the US yield curve, where long-term rates are now cheaper than short-term rates, is a clear sign of higher risks for the United States economy next year. Despite this, the US dollar is continuing to strengthen, especially against the euro and the pound, as Brexit risks pick up, but also against the Aussie dollar and the Chinese yuan, which is above 7 for the first time since the GFC. In many ways, the Australian dollar is a proxy for the Chinese economy and emerging markets. Therefore, as uncertainty grows, the US dollar is in demand, despite their falling interest rates. So, we continue to expect a weakening Aussie dollar, still likely to reach 65 cents, which remains good news for export markets, including service exports, especially local tourism. The unrest in Hong Kong and some weaker data from China have added to this trend. However, the other dependable trend at present is falling interest rates, with our 10-year government bond below 1% for the first time on record. And the RBA cash rate likely to be reduced by November and again next year to 0.5%. Although unlike Japan and Europe, the prospect of negative interest rates is still pretty remote. The main takeaway from recent RBA comments isn't just that there are more rate cuts coming, it is that rates are highly likely to remain low for many years, which is a massive shift from where we were just 6 to 9 months ago. This in turn should support asset prices, especially housing. So the 15% fall peak to trough for Sydney and 12% for Melbourne property is likely to have mainly run its course. And property prices in other cities and regions should also benefit from lower rates, the tax cuts, and some easier policy settings. How these ultra-low rates impact stock markets is a tougher call, although it is worth noting that despite all the media hype on falling stocks, we're still less than 4% below the recent record highs. And record low interest rates may artificially inflate asset prices for a while. But when thinking about geopolitical risks around the globe, including Hong Kong and China, Brexit and trade tensions, a cautious position still seems the most sensible one. And lastly, Australia's updated GDP growth rate is released on Wednesday the 4th, which may slow further to around 1.5%, with exports adding to growth but domestic consumption dragging the chain. So, we may need more time before the recent rate cuts and tax cuts lift consumer confidence and business investment. And that's the market update from Bendigo Bank.